Okay, Sarah, why don't we dive right in and let's talk about the leadership transition at the SEC first. How has this period been for you personally, and what's it been like balancing these new responsibilities while continuing with your other role as well?
So I think doing two jobs can be a bit of a juggle at times, but I will say that IM has a terrific staff. So getting the opportunity to work much more closely with a range of staff from across the division during this period has been, I think, a real pleasure and highlight for me. I think the other thing I've observed being in this acting director role is really the constant change and new issues that are always coming in across the asset management industry. When you get to have a bit of a touch on everything that pops up on a weekly basis, it really does give you that great across the board view. So I think that's been really interesting and a highlight as well.
So understanding that this obviously may change when new leadership comes in, what can you tell us about the division's current priorities?
Yeah, so as you mentioned, we are in a transition, and this is both at the chair level. Some of you may have watched our chair nominee, Gary Gensler, had his confirmation hearing yesterday, and also at the division level, where both our director and deputy director both left in January. So it is definitely a time of transition for the commission and the division. So I'm sure actually at your next conference, you'll have an even more concrete vision of what some of the division priorities are. But for now, I can tell you we certainly are focused on carrying on the work of the division. For one thing, there are, as you've mentioned, a large number of rules that we adopted late last year that were very focused on implementation, answering questions, making sure that there's as smooth a transition on those as possible. So I know we'll be talking more about some of those in both this session and in the rest of the conference, but that certainly is one area of focus for us. We're also, I think, continuing to work on some of the rulemakings, for example, that have been on our Regulatory Flexibility Act agenda, which we often use as our public-facing way of talking about some of the active areas for the division. And I think one thing people have probably seen as an area of constant focus for us is where our regulation has become outdated, either because it's an old rule or just because the asset management industry has evolved over time, or there are market events like last March, and we need to catch our regulation up. So I think you'll see that will continue to be an area of interest in terms of priorities. So I know we're going to touch on things like custody. That obviously has been an area we've been looking at, particularly with the evolution of digital assets. Also things like money market fund reform, that's an example of an area we're looking at based on the events of last March. So, and I'm sure there will be things that our incoming chair and division director will want to add to our plate as well. So I think you'll see some continuation of us looking at these areas, as well as the priorities that our new incoming leadership will bring.
Well, that's very helpful, and we will come back. We'll circle back and talk a little bit more in detail on some of the rulemakings that you've mentioned. But in the meantime, why don't we jump to the pandemic? I don't think we can have a panel, in today's environment without talking about response to COVID. And I'd like to just talk a little bit about the SEC's response. So the division and the SEC in general they've just done tremendous outreach to stakeholders in general, to the IAA, and you've taken a number of very helpful actions in response to the pandemic and concerns that we have raised and that others have raised. So we appreciate the proactive outreach and responsiveness. There is some relief that's ongoing, and so I'd like, if possible, for you to address that, and also tell us if there are any updates on the ongoing relief.
So I would mention there's ongoing relief. I guess actually the first area I'd mention is we did do an e-signature rulemaking near the end of last year for Edgar filings. So that's one thing I would point out that I think that area started as an area of relief, and then we tried to put something a little more permanent. So we are trying to learn in cases from cases where, there's relief and it makes us think we could make this a little easier on an ongoing basis. So that's one example of that I would point out. I know another area of relief that has been used very heavily and people are definitely interested in is the in-person board meeting relief. And I think people can really expect that to be in place as long as this pandemic lasts and there's a need for it. Certainly, people's health is a priority here, and that relief very much makes sense while we're in these circumstances. There are also relief on international mail service suspensions. That's still in effect from time to time. That definitely pops up. We know it's a global industry, and sometimes there are jurisdictions where that's needed. So that continues to be in effect. The other thing is there's quite a few very focused areas of relief that are more focused on the fund side, and some of that remains in effect. We do look at that from time to time and decide whether extensions of any particular areas are warranted. For example, just this week, the staff extended until March 31 of 2022. So basically for another year, no action assurances for BDCs with co-investment orders for engaging in certain transactions. So it is an area that we keep going back to and look at. The other thing I would highlight is that we did do a number of FAQs. So not everything was done in the form of, commission exemptive relief on matters that have also been affected by the COVID-19 pandemic. So those continue to be out there for people to look to on things like electronic processes for 13F confidential treatment filings. I know we get around that season, and that often gets quite a bit of activity and use. Form ADV disclosure on temporary teleworking addresses. I imagine that is still something that people are looking to, as many people are still in that telework posture. Disclosure obligations for advisors that receive PPP loans. That's something I can see people continue to look to. So I just note that it really did come in many different forms and flavors. And we do, have a central spot on our website where we try to collect together information on that and encourage people to continue to look as there are updates.
Yeah, I'm glad you mentioned the FAQs as well as the more formal commission action, because they really, the staff and commission took a lot of action in response to concerns. One thing that I would expect, or I wouldn't be surprised to see, is if you get some requests to consider making the in-person fund board meeting option permanent and not just during the pandemic. I think you might see that, and it's certainly something that we've heard interest. We've heard some interest in. One other thing I'd like to raise, it's not something you gave relief on, but it is related. It's an area that we've been talking about for a long time, but it really was put into stark relief during the pandemic and remote working, which is the whole notion of Edelivery. And there were some statements sort of late in the last term about sort of looking at it and reconsidering it. And I know that Gary Gensler was asked and had some comments about it at his hearing yesterday. But I wonder if you could sort of tell us about the staff's current thinking on the issue of moving from a paper default to a notice plus access electronic default preference.
So I think this is an area that we have been thinking about, I think, for a number of years. I'll say, at least personally, on every time I think I've worked on a disclosure rulemaking, and there have been several, e-delivery is definitely a topic that always comes up. And then, of course, with the pandemic, that has, I think, put e-delivery in an extra different light as people have, I think, both discovered new value. I'm sure you've seen it. Additional people opting into e-delivery who were paper-based before and didn't want to wait, either discovered that it's easy to get it online or just didn't want to wait for it to come through the mail service. So I think we are looking and gathering information on all of that. I think it would be helpful to continue to engage. I think one thing we always remain focused on this is that people get information and have the ability to get it in the way that they prefer. And those preferences can evolve over time. We understand that. But one thing I think I've found in this space is there are a million different variations of, what happens if they apply this way? And if they check the box here, is that sufficient? What if they just give an email address? Is that sufficient? And so I think the one thing, at least I've found, is there's a lot to dig through in terms of questions of how has someone expressed a preference on e-delivery. So I guess that's one thing I think I would say it's an area we're always looking at. And if people have experiences to share on that, I think it would be really helpful. We know that many of your members are out dealing with clients on a day-to-day basis and have good experiences and information on, what they've heard from their clients on this. So keep sharing that information with us. And I guess I would say particularly as they've had new experiences through this pandemic on people's preferences here.
Well, thank you for that invitation. And I think that we will definitely take you up on it and try to put together a group of members to come in and and give you some information that would be helpful on what they're seeing and the challenges and opportunities that they're seeing based on what clients want. Let me switch gears a little bit to something that you mentioned, which is the money market reform. And the President's Working Group, the PWG, issued a report on money market reform in the context of last March's market volatility. So it's pandemic related. Can you give us a sense of what the Commission is looking at here, and what would be most helpful for you to hear from folks?
Yeah, so as I'm sure many in the audience know, back in March, during that period of market volatility, when the pandemic first really sunk in and the economic uncertainty associated with it, there was basically another run on prime money market funds. So that caused us to evaluate what the data on what happened and put out, as you mentioned, a President's Working Group report that lists a range of options, pros and cons. I think anyone reading it can see that this is a challenging area to think through. And what we're hoping to do at this point is really to get feedback on the options discussed in the report, as well as any other options that your members or others in the public could have on ways of solving this problem. I think our goal really is to get to a point where money market funds and the short-term funding markets are resilient and don't have these episodes in times of stress. And so I think we're at the stage where we are really brainstorming, trying to dig in on potential solutions here. And we really would welcome people's feedback on, what they think may work to solve this problem for once and for all, and why. What behavior do they think was at stake here? What would change that behavior? So I think just really digging in analytically and explaining why they think their potential solution could really make a difference here. And so this is obviously going to be an agenda item for the Commission to look at reform here.
Yeah. And that's actually a helpful, the way you characterized it, I think is a very helpful way for us to think about it. Let's pivot again to, I think, what is going to be the favorite topic of our conference, which is the new marketing rule. And congratulations on getting that out. We have a little bit of a sense of how much work went into it on your end, and certainly a lot of work went into it on our end as well. We have a panel later that's going to drill down, and we have one of your staff people, Melissa Harkey, on it. So thank you for that. But I do want to ask you a couple of questions on it. Before we get to substance, there's a lot of chatter around the status of the rule. It hasn't yet been published, as far as I can tell, at least I think as of this morning, it hasn't yet been published. Can you give us a sense of where you think the rule is in terms of status? And also just speak a little bit about, once it does go into effect, that 18-month sort of compliance runway.
Yeah, so I think it has the typical effective date of 60 days after publication in the Federal Register. I'm sure many of your audience don't spend their time focusing on the mechanisms of the Federal Register, but I will say it's been our experience as of late. They take quite a long time, the longer the release is. And as you know, Gail, this was a pretty long release. So just to give people a ballpark, I think for shareholder report disclosure reform proposal of last year, it took about 3 months to get published in the Federal Register. So sometimes it takes a little bit of time, but just be patient. We're hopeful it'll be published soon. And then that will give people firm dates. And then again, the 18 months goes after that. So we understand everyone gets a little uncertainty until that Federal Register date is there, but hopefully you'll have certainty soon.
Well, that's very helpful, Sarah. Thank you. Turning to the rule itself, can you talk about some of the issues that you and the staff found particularly challenging?
So this was a challenging rule because we really did take a fresh look at the entire landscape in not one but two rules, and then at the end of the day decided to merge the two rules into one rule. So I don't think I've worked on merging two rules together before, and that added, I think, additional complexity to it, but we thought that approach actually added clarity, because I know a lot of the comments we got were about the overlap between those two rules and when does a solicitation become an endorsement. And so in our minds, this actually, at the end of the day, provided a lot of clarity by one rule covering the whole space. But that definitely added its challenge to it. It also, I think, was a challenge just because so much had changed over the time since we had last looked at these rules. Practices had changed, technology had changed, and really public preferences for how they gather information in our minds changed. And so to look at that entire landscape and give it a fresh look added, I think, hours of discussion on our end. The other thing is we certainly were aware that a lot of firms out there, operate in a world where they look to other guidance for how to advertise and market in this area. There are FTC guidelines that lots of people are very familiar with. There's FINRA rules for everybody who is subject to those. So we did try and take that bigger perspective and understand where there could be intersections so that anything we were doing was mindful of where we were either converging or diverging from other perspectives. And then the last thing is there were a lot of perspectives to consider on this. There were a lot of commenter perspectives who wrote very thorough, long, and helpful letters for us to consider. There were, 5 commissioner perspectives to consider. There were our excellent colleagues in the Division of Economic and Risk Analysis who offered their economic perspective on it. So again, taking all those perspectives together with everything I've said before, it was definitely a complicated rulemaking.
Well, we are obviously thrilled that it's come out, and we're waiting with bated breath for it to be published. But I do want to commend your staff once again for, even now that the rule is out, for the willingness to really work with the industry on interpretive questions, and just the open door policy has been immense, I think across the board, but in particular on this rule, we're very grateful for it. One of the things that is talked about in the release is what is going to happen with the slew of no action letters that's out there on these two rules. Can you tell us a little bit about the process and how you're going to sort of be attacking that process?
Yeah, so I should say that was, I think, yet another thing that made this rulemaking challenging is that there were so many no action letters out there, and we did want to act cognizant of that. I think this is an area where I think there was almost as much lore as law that we had to grapple with. And so on that, we are putting together, there is a list that will ultimately come out, hopefully not too far in the future, that will list, and it is a long list of no action letters that will be withdrawn. So the one thing I think that's maybe takes a little bit of extra time when you want to be certain you've gotten everything exactly right. And then there are definitely some letters that will just be a partial withdrawal of the letters, because certain no action letters cover multiple things, and it is only the portion of it that is superseded by this new rule that would be withdrawn. So that takes a little bit of extra time and care as well.
But the goal is, what I'm hearing you say, the goal is to give folks clarity about,
yes,
what is the one place that they can go and look to try to sort of understand the obligations under the new rule. I think that will be incredibly helpful. You also mentioned at the beginning of our conversation your work on custody, on the custody rule, and that's obviously something that the IAA has also been talking to you about for a long time. The division sent us a letter a while ago on the whole non-DVP settlement issue, and also asked about digital assets. And there have been some other statements on custody and digital assets. So can you tell us a little bit about how you're thinking about approaching that rule? And I'm interested in hearing both whether you're going to take a fresh look, a real modernization effort at the rule, sort of the way you did with advertising and solicitation, and sort of from the ground up, and also what are the specific issues that you're thinking through?
Yeah, so I would say custody is not quite like marketing, because it has been looked at more times and more recently than I think, the advertising rule, I think, was from the 60s. So that was, I think, almost in a league of its own on ones that had been untouched for that long. So with custody, I think there are a couple of areas that will be under consideration. I think one is just clarifying the scope of custody. I think this is an area where there's been confusion. I mean, I think just the sheer number of FAQs we've issued on this over the year attest to that. And also an area where I think it could help, just because I think when people see the word custody, they think of such just literal custody, like I physically have this stuff. And as you know, the rule as it exists now covers more than that. And so I think that's one area where I think we could do better in terms of clarity in that space. So that's, I think, one area of focus. Another area of focus is emerging areas like digital assets, as I mentioned. How does the custody rule interact in that space? What's required there? So, and I'm sure some of you may have seen a letter that we issued recently in response to the Wyoming banking regulator and their own legislation in the area of digital custody and how it may interact with our rules. So I think we've put out questions in that letter that we would be interested in. We welcome any thoughts in that area. So that's another area of consideration and focus. And then I guess, too, all of that I'm sure we will be giving a look just at whether it is giving appropriate and adequate protections. I think that's always a core concern whenever you're in the area of custody. And then the last area I think we'll probably give some consideration to is just the intersection between the investment advisor custody rule and then the various custody rules on the registered fund side, and just where there are differences in approaches. Do they make sense? Is there a reason for that we can readily identify? Or is there any way that there could be some parallel modernization on that side that would make sense? So a variety of areas I think we would consider in that space and have been thinking about.
That's very helpful, Sarah. Thank you. I want to switch to talk about just one other rule that was also on the Reg Flex agenda for a new look, and that's Rule 17A7, which is the cross-trading rule under the Investment Company Act. The recent rulemaking that the Commission did on fund valuation updated the definition of readily available market quotation, and it provided in the release an interpretation of that term as used in Rule 17A7. Sorry, folks, that this has gotten technical. We'll bear with us. IAA members have raised a number of questions about the effect of this new interpretation on the cross-trading rule, particularly for fixed income cross-trades, and also on the timing of when that new interpretation is going to apply to the cross-trading rule. And that's sort of based on when the fair valuation rule, the compliance date for the fair valuation rule. So it would be helpful, I think, to get your reaction on whether the compliance date for the fair valuation rule is going to be the same for the interpretation on 17A7. And also, our members are really hoping that the work on Rule 17A7 is going to continue, the sort of revamp of the rule. So if you could try to address both of those pieces, that would be great.
Yeah, so the compliance date is the same across the board. So that is So I think it's a September 8th, 2022. So 18 months people have on that. And on the staff's look at 17A7, so I think this is another area for the theme I mentioned earlier of areas where markets have changed, things have changed, and looking at has the rule really caught up? Rule 17A7 really did originate a long time ago, and markets have changed tremendously since then. And I think in particular, in terms of the practices of where people really want to cross trade, what we've heard is fixed income is the largest area where people are interested in cross trading. And if you look at the rule, it's mostly talking about exchange traded, pricing information for that. So it's a rule that just has not caught up to how markets have evolved and the practices. And so I think our hope there is, we understand the benefit case for cross trading, where there are cases where it can be beneficial for both funds, but there are also a number of risks and conflicts. In particular, it is an affiliated transaction, and we need a regulatory framework that really manages all of that in today's market. So I think that's our focus there, is just looking at it freshly.
So I'm very glad to hear that that the fresh look is continuing on 17A7. And one thing that I would sort of throw out is a suggestion for the staff, to the extent that you think that there's ambiguity in the release about the compliance date, whether it might be helpful to the industry to have some kind of formal FAQ on that. It might give folks comfort. We have just a couple of minutes left, so let me switch to another sort of topic du jour, which is ESG, sustainable investing. We expect the SEC to be focused on ESG. It's going to be an area of increasing focus. You did publish, or the SEC, sorry, published a request for comment on the fund names rule, and asked a bunch of questions around ESG. So I'm wondering what feedback you've received specifically on that rule, and what would you say are the main issues there?
Yeah, so we did publish, as you mentioned, a request for comment. We obviously got a broad range of comment on that, on the ESG aspect of the names rule. I will say, though, we also just got a lot of broad comment on ESG topics more generally, beyond just the names rule, through that request for comment. So that, of course, is helpful for us too, as we think more broadly about that topic. But I would say that work, we definitely have been actively wading through all of the comments on that and looking at next steps. So it's sort of too early to say where we'll focus most heavily on that, but we did get a broad range of input on all aspects of ESG through that comment process.
Yeah, and you're getting some more input even from the Asset Management Advisory Committee, which published some potential recommendations on ESG in December. I wonder if you could sort of share some thoughts on that. What did the recommendations focus on, and to the extent that you can sort of talk about how they might be integrated?
Right. So what these were preliminary recommendations from the subcommittee. There was a ESG subcommittee of the AMAC, or the Asset Management Advisory Committee. And so they are now going for consideration by the full AMAC. But what those preliminary recommendations covered, first, they recommended that the SEC suggest best practices to enhance ESG investment product disclosure. So this is not at the level of like a fund, but at like a corporate issuer. So they recommended enhanced disclosure at that point. And then also for each product to describe its approach to share ownership activities, and also any recent ownership activities outside of proxy voting. So that was their first set of recommendations. Their second set was on adopting standards to guide disclosure by issuers of material risks specific to ESG investments. And so, as I mentioned, this now goes to the full AMAC, and I think they expect to be looking at whether to make final recommendations in the first half of this year. And we in the staff look forward to receiving those recommendations and considering them.
That's great. So, and we at the IAA are obviously following it pretty closely and are looking forward to that as well. At this point, let me ask if Dr. Alex Schiller can join our conversation. Alex is a financial economist and is the Assistant Director of the Office of Asset Management in the SEC's Division of Economic and Risk Analysis, also known as DERA. Welcome, Alex.
Thank you, Gail.
Good to have you with us. Can you very briefly describe what is DERA and what is your office within DERA?
Sure, yeah. Well, first, thank you for inviting me to participate in this discussion, and thank you to Sarah for providing the disclaimer for both of us. So DERA is the Division of Economic and Risk Analysis, and it is the place that really houses most of the economists that work for the Commission. And the division supports really all functions of the Commission, including rulemaking, examination, and enforcement with economic analysis and data analytics. My office is the Office of Asset Management, and I think the best way to think about what we do is to think of us as the counterpart to the Division of Investment Management when it comes to rulemaking in DERA. So this means that really our main work product is economic analyses as part of rule releases. We also do a number of other things. For example, we analyze new financial products, such as exchange-traded products, or applications for those products.
So before we go on and get into the meat of things, I'd like to just announce the second code word for continuing education. It is management 2. No space between that and the number 2. So management and the number 2 without any spaces. So Alex and Sarah, can you talk a little bit about how the Division of Investment Management and Alex's office collaborate on rulemakings? You know, as data has become increasingly important to the rulemaking process, I imagine that there's been an evolution in your relationship, and I think it would be very interesting to hear a little about that.
Sure. Should I start? Cool.
Sure. Go ahead, Alex.
So I think when you look at a rule release, there's what we call the front end and the back end, right? In the front end, the Commission tells people what it is that it's doing and why. And then the back end starts with the economic analysis. That suggests kind of a sequential character to things, but behind the scenes, that's not really what's going on. The process is very much a parallel one. For example, early on in a rulemaking, there's often the need to look at data or the need to look at the academic literature, both of which are things that my office does. Another example is the comment process. For example, a commenter might ask to speak to staff at the Commission to follow up or provide more detail on a comment letter they submitted. And those meetings, usually DERA staff who's working on a rulemaking will be in the room. I guess nowadays they'll be on the phone. And I guess one additional point before Sarah can take the rest of the question, but information really flows both ways, right? So in DERA, we're mostly economists, which means we're not attorneys. And one key area that is important for us to really understand in all its details is the regulatory baseline and how a given rulemaking ties into that. So that is really key for us to work out the economic effects that we anticipate.
Yeah, so I'll just add to that DERA really has become an essential partner in all of our rulemakings. As Alex said, they are on the team from the start. And so this is when we're initially brainstorming, what is the regulatory problem that we're trying to solve here? They have a key perspective and input on that. And sometimes it's analytical, as he said, sometimes it's been studied in the academic literature, sometimes there's empirical studies of it that they bring to bear. Sometimes they'll do data analysis of their own on it. So that's a really valuable perspective that they bring from the very beginning. They also offer, as he mentioned, a very different perspective that is valuable. They're not lawyers. That's one of the main benefits. They challenge assumptions we're making, and they approach things differently. And I think I'm a firm believer that this whole process benefits from diverse perspectives and people, challenging every mode of thinking, kicking the tires, talking about what could be unintended consequences and the like. So that's another value they bring. I will say, their role has changed, I think, significantly over time. When I started at the SEC a little over 10 years ago, they played a very different role. And they've really grown to be a key partner in our process and, a very collaborative process from start to finish now. So as Alex mentioned, it's sort of from the start, we'll collaborate on when we're at like a term sheet level. They're sort of there going back and forth on the ideas. We're going back and forth, on their asking us things as we're framing out, but then as they're from the very beginning laying out how, from an economic or perspective, you would look at this, and we're asking them questions. So it really does go both ways. And I think hopefully Alex would agree that we've both benefited a lot from all of our discussions and collaborations now over the years.
Wholeheartedly.
I'm going to stay with you, Alex, for a little bit and learn more about DERA. But Sarah, I really want to thank you for joining us today. And congratulations again from the IAA on your acting director appointment. We wish you the very best of luck. And thanks again.
Thank you so much for having me.
Yeah, anytime, please come back. Alex, I think it would be interesting to hear about the process that DERA follows with respect to a rulemaking, and in particular, if you can talk a little bit about how you collect and then assess data.
Oh, sure, yeah. So let me talk about process first, and then I think I have a really good example on the data side of things. So DERA is a pretty large division. We have about 80 PhD economists, of which about half support rulemakings. For every given rulemaking, an economist or a team of economists holds the pen on the economic analysis, again, working very closely with staff in the Division of Investment Management, as we just discussed. The chief economist plays a key role in the process in that he or she reviews every economic analysis and also is required to provide his or her concurrence before a release goes for a commission vote. One point which may or may not be obvious to this crowd, it probably is, but economic analyses, they are explicitly part of the notice and comment process, right? So in a proposing release, we'll present our initial economic analysis, and we explicitly solicit comments on all aspects of the analysis, including data. And then based on the comments we get for the adopting release, the final release is informed by those comments and responds to them. In case people are interested, there's a document that is available on DERA's website, which we lovingly refer to this as the guidance. It's from 2012, and the full name is the Current Guidance on Economic Analysis in SEC Rulemaking. And this document lays out in great detail the guiding principles that we apply in economic analyses, and talks about different kinds of costs, different kinds of effects. It talks about issues such as quantifications, for example. So in terms of process, the goal really is to ensure that we have a rigorous and balanced economic analysis at the end of the day. The second part of your question, Gail, is about data and how its use might have evolved over time, and also how I think the comment process plays an important part when it comes to data. And I think a really good example is the recent funds use of derivatives rulemaking, which the Commission adopted very recently. And the first time the Commission looked at this was in 2015, when a rule was proposed. And when we first approached the issue of developing a framework for how funds use derivatives, we wanted to understand how is it that currently funds use derivatives. And so we wanted to establish things like notional amounts by type of derivative, by type of underlying, for example. And the best data we had available to us at the time were filings on Form NCSR. And those filings were not available in a machine-readable and structured format. That meant that we couldn't write computer code that would, in a very efficient manner, analyze filings of all funds for us and aggregate it into the numbers that we're interested in. Instead, what we had to do is go in fund by fund, look at these filings, and pull out information about the derivatives holdings and aggregate those into the statistics. We were only able to do this for about 10% of funds. We drew a random sample, and that still meant looking at about 1,200 filings. So that was a very slow and drawn-out process. At the end of this, there was a white paper that DERA published on its website that actually went out together with the proposal. Fast forward to 2019, when the Commission reproposed a rulemaking for funds' use of derivatives. And here we were in a much different situation. We had from endpot data available to us, which is machine readable and structured, where we can write computer code in an automated way, produce these statistics. Perhaps one additional example also related to the derivatives rulemaking is at a very high level, depending on how a fund uses derivatives, they might be subject to a value at risk-based test. So what we wanted to understand is, under the baseline, what are these value at risk-based metrics for funds? And it turns out doing this from the outside of a fund for the whole industry is very challenging, just because the types of derivatives and their uses and how they tie into funds' portfolios just vary so much. So what we had to do is make some simplifying assumptions that allowed us to arrive at good approximations for these bar levels. And that was part of the economic analysis in the proposal. What then one commenter did, this was the Investment Company Institute, they actually surveyed their members and asked them, would you be subject to this bar-based test? And if so, where would you land on these bar metrics? And that analysis was very much complementary to our analysis because the analysis was able to leverage kind of existing data analytics infrastructure that funds had in place.
So let me just make an observation that only an economist would use the words lovably and economic guidance in the same context. So kudos to you, Alex. We have just a minute or so left, but I wanted to ask you about something that always strikes me when I read the economic analysis part of a commission release is how low DERA often projects the number of compliance hours to take. And it always strikes me as, it takes me, I think I've mentioned to you, days to read a release. And so I'm very curious about how these numbers are arrived at and how you look to industry to help you with that data.
Right. So good question. I think, so if I were to give a theme to our short discussion right now, I think it would be we strive to be kind of fair and balanced and accurate. And the notice and comment process, right? The example I just gave about the ICI comment letter providing us data, that is really key for us to help make sure that we arrive at a high quality work product. And I think, given that our time is coming to a close, I think this might be a good opportunity for me to just emphasize that for those of you who are providing comment letters, if you have any insight into any aspect of our economic analysis, please do share that with us in the comment letter and try to be as specific as possible, because this really is helpful in the work that we do.
I think that's an excellent takeaway, Alex. Thank you. Be engaged, be involved. If you want DERA to consider your data, let's try to help provide the data. I think that's a great takeaway. So, Alex, thank you again for joining us.